Good evening, guys. Ken at Tortoise Capital. This is the Nightly Strategy Podcast for September 3rd, 2020. And the market cracked today. So, as regular listeners have, been painfully aware of, we've been watching this move of the last 30 days, which had, a sideways move, a nice leg up. That was really the second leg up, a third leg up, and then yesterday's extraordinary, looks like an exhaustion pop to take it out past Z2 and close above the Z2 river edge of the floodplain. And we noted yesterday that the 10.5% gain from the last 10 days, if you annualize that, would be out around 120% compounded annually. So we have been noticing that when you have abnormal moves, you have to be even more vigilant about managing your stops to make sure that you retain more of the gift. Like, you're not entitled to expect an abnormal gain all the time. Otherwise, it would be normal. So when you get an abnormal gain, you go through a process of deciding how much of that abnormal gain do I want to retain as my money, and how much of it am I willing to let the market play with to give it even more room. Well, giving it more room to run has been a strategy that has paid off during this entire move. In fact, yesterday we spent the time to go through how we've been building swing trade positions by retaining partial positions from each of the intraday trades. And we've been building up those positions with market's money, and then using a relatively tight stop in order to protect against exactly the kind of move that we saw today. So if you're interested in that one, the strategy podcast from yesterday is a perfect example of how to trade in these abnormal times, and how to get a nice trade-off between what feels like easier money on the intraday trades and allowing yourself to be carefully exposed to the overnight trade using market's money. So it's a trade-off decision on how aggressive that you might want to be, and it requires you to differentiate between your core portfolio, your seed capital, and a portion of gains that you're willing to let the market manage, or give it some room to play. And so we went through that decision space yesterday. And so if I can for a moment just hit the highlights of that one, what we talked about yesterday, and I'm going to hide today's move just for a moment, just so that we can focus on what we said yesterday. So yesterday we noted that the PSAR stop yesterday was here, and we projected that the PSAR stop would be here today. And then we looked at a series of possible stops. And so we talked about the one-day low. We talked about the Z2, the projected Z2 line. We talked about a one-day low here. We talked about the edge of the dragon, the spine of the dragon, the Z1, the belly of the dragon, and then yesterday's PSAR. So we took a look at this entire stack, and then we took it all the way down to what we projected to be the 10-day low today. And we went through various and sundry reasons why you might want to pick one or the other of those. Now, under normal conditions, such as back in here when the market is kind of grinding up, if I say it that way. So when the market is grinding up during this period, you'll notice that the PSAR and the dragon are not that far away, and all of the price action is in here between Z1 and Z2. So that's sort of a normal grinding bull. It's out of the river, but it's not an extreme. And we noted that whenever the markets got out to Z2 and beyond, that it was often followed by a period of consolidation, if not selling off. So we saw that here. We saw that here. It kind of consolidated for a couple days. If we go back even further, we noticed that the last Z2 excursion here featured a pullback into the river and a consolidation before it took off again. So it's not unusual to see exceptional gains get to a Z2 level like they did here. This one was kind of the anomaly. We actually went through the same warning in this doji. We said, hey, this pushed out to Z2 and didn't really advance any further with the doji. Be ready for a sharp sell-off, because that's what the risk Z was telling us. The steepness of the 10-period regression line was telling us that this was really an extraordinary move. And so we were prepared with a tight stop here at the one-day low. It didn't materialize. It had a gap up and then kept going for another 3 or 4 days. So we were open to the possibility that this thing could keep going, but we were mindful of the possibility, the increasing probability of a sharp adverse move. When everybody is on one side of the trade, even the fat kid and his cake is on one side, there's nobody left to buy. There's nobody left to sell it to. And then what we saw today was what the options guys call a gamma collapse. And that's a momentum leveraged based reversal of fortunes that starts in the options and then quickly proceeds through the futures and then to the stock symbols themselves. And then that inverse momentum starts taking on a life of its own. And so you end up getting the first move in the counter trend. So after an exceptional move in one direction, that first day of correction in the other direction is often the biggest move. It's either a dead cat bounce from the bottom or it's a collapsing trade from the top. And that's what we saw today. So we went through in the briefing yesterday, we went through and talked about all of the different reasons why you might use these different technical levels of support and resistance in this stack. And then it's really a matter of personal preference to decide how much of this move of the last 10 days did you want to keep. And I made the argument yesterday for being halfway up the stack and certainly not less than the one day low. So I was happy with a decision to be here or to be here. So when we ended up getting we got an orderly opening today. So let me just pull these out of the way a little bit so we can zoom in. So we got an orderly opening. Where there was a fractional gap down, but it was inside yesterday's real body and inside yesterday's range. So this is what I would call an orderly open. This is not an exceptionally large gap, but right from the opening, this thing started to collapse. Every sector, every stock, every index all started pointing the way down. And so I took my exits at the one-day low here, which turned out to be about just above a 1% sell-off. And this is about where I got filled. So I hit the button here, and then between my various fills, I got filled at about this red line. Now, this sets up a nice intraday directional trade. The size of this move from the top of the day to the low of the day is the size of this red arrow. And so you can see it's more than 2.5%, not quite 5%. So that's really about 3.5%. That's almost it is a 4 ATR adverse move. So that is an exceptional, abnormal intraday move. And as often happens, it's very directional, almost all signal and no noise. So we call noise anything between the real body would be between the opening and the close. And then all of these tails then become the noise because it was a reversal. And so this was mostly signal today. And then one of the things you notice again is that 2 times out of 5, 2 days every week, the opening is within 10% of either the high or the low of the day. So you get twice a week, you can expect to see a very directional move. Now, this one just happened to be 4 ATR in size, but in other cases, like this day, 7 days ago, it opened near the low, and then most of it was signal, and it closed near the high. So that was a directional day, and that made hybrid frog trading very lucrative. This day, 3 days ago, was directional to the upside, and even yesterday was directional to the upside. So you have large bodies of directional moves and small tails, which is noise. So that gives us the idea of signal versus noise. So the point I want to make is that yesterday's strategy podcast talked about how to think about preserving gains as well as seed capital after an abnormally large move. We knew it was abnormally large because we measured the statistics of the different size moves. And then today it was a regular gap down and then a directional sell-off all day that went 4 ATR. The price came all the way down to the PSAR and beyond, and then reversed and closed just fractionally higher at the southern skin of the dragon. So let's look at all of the support levels that triggered. And so depending on where you put your daily chart stop level for your swing trades, this would have been confirmation of a downward move, and then you could lock in your gains. So we looked at the baby dragon from yesterday, which was yesterday's daily low. We looked at halfway down the stack. We looked at the upper skin of the dragon. Let me lock in those prices now so you can see. So we looked at the upper skin of the dragon at 350.40. The spine of the dragon, which is the midpoint of the orange dragon, 347.87. The low of the dragon was 344.10. And then we looked at the PSAR. We looked at the 10-day low, and we said yesterday, well, there was no reason to let it ever go that low, because otherwise you're giving back most of the abnormal gains. So when you're given a gift, in my opinion, you want to take advantage of that and lock it in. That's why we were using a pretty tight 1% stop from the highest high while in the trade. So we were willing to trigger here, and then that you end up getting filled either between there or the low of the day. So when we look at today, we now notice the size of this move, 4 ATRs. The price violated the PSAR and then rebounded. Now, the PSAR doesn't flip because the PSAR is taking the input of the RL10 in order to compute the location. So it's going to take a few more days of the RL10 to decay. So if we were to predict or forecast that RL10, the RL10 is probably going to decay, I would say probably on that same slope. It goes pretty fast in that direction. And then if we projected the PSAR to approximately continue in the same direction, this will probably PSAR flip in 2 days, not tomorrow, but probably the day after. And it'll probably flip around 346. And when it does, that new PSAR dot usually is going to get drawn at the peak of the RL10. So for future reference, 2 days from now, that PSAR top level is going to be about 356. So it's going to come in right about here when it does flip. And so that tells you the space between the peak of the RL10 and the PSAR dot, wherever it's drawn. That's really the yellow zone, or the price that's in play. So it would take now a price that exceeds the peak of the RL10 to really convince us that this trend that we've seen is really starting to work. So I wouldn't be uber favorable on this until we saw a breakout above 356. So otherwise, any rebound that comes out of here is just a tactical play. So I'm going to draw that as a dotted line. That's going to be a tactical move. So we are more likely to cash the intraday moves. We don't have any confidence until it takes out the previous peak of the RL10. Then we could then pick that up. So all tactical plays now between the current price and 356 a bird in the hand is going to be the basic approach that we adopt. Okay. Similarly, until the RL10 breaks below this PSAR, this is all tactical play inside this yellow space. It would really take the RL10 to get below 344 to really pick up a downside bias. Now, in the meantime, we're willing to go short tactically, but until the RL10 kind of confirms the crossing of the PSAR, we don't adopt a downside bias. So we are in a directional neutral bias right now until the RL10 gets below. So that tells us for the next 2 days, really, we should be really just concentrating on the intraday trade and leaving the swing trades alone until the market decides what it wants to do. It has to get out of this, what I've drawn as the yellow zone. It has to get out of that yellow zone before we pick up a directional bias. So let me clear the deck here with some of the stuff so we can see. So the things I want to highlight here then, I want to highlight the importance of using the daily chart, saying, hey, this 353.4 was a really significant price level. That until price breached yesterday's low, all we could say for sure was that this could be just a tactical move. Like it could have come just down here to 353.4 and then rebounded strongly just like it did yesterday. So until price breaches yesterday's low, we don't have any new information that today is a runaway sell-off day until that price level is violated. That's why I put my stop there, because once I've got that new price information, I can now adopt a tactically short orientation. Okay. And similarly, you might pick each of these subsequent support levels as ways to confirm that selling pressure really is significant. And you could have tied that to some decision points as well. But for me, as I articulated yesterday, a 1% sell-off from this abnormally strong 10-day move was sufficient for me to get rid of my swing positions. And there were a number of them. We went through the triple leverage tech, had 9 intraday positions built on it with markets money. So I was eager to get out of that one. I just couldn't wait to get out of it. And then the same also with the clean energy, Twitter. Those positions were exited. Now, treasuries did fine today, so that swing position is still in play. We'll take a look at that one a little bit later. So, in my view, this abnormal gain where we had, the 10-day low, and it moved all the way up to this 10-day high, that run is over, and we have a new mentality that is justified on the basis of the size of this abnormal move today. So as I look at this layout, I'll look at it clean now. So I'm taking a look at this, and for me, the fact that tech has sold and the market has sold off so much is going to trigger a certain amount of buying pressure, because you can make the argument that it moved 75% of the way back to the mean. And as long as this market has a strong upward bias, what you have is the opportunity to buy quality on sale. So as an example, Tesla is down 20% from its all-time high. And if you loved Tesla at 500 3 days ago, don't you love it now at 400? Long term, if you got a 2-year time horizon, you get a chance to buy a great American company on a 20% fire sale. Now, if you have a shorter time horizon, maybe you want to be more tactically sound, but there's a certain amount of institutional money that wants to own Tesla that may be attracted to it. And so now the very magnitude of the sell-off is going to start raising the question, when is buying pressure going to start coming in? So that's the reason for the next couple days, I'm going to be adopting an intraday only tactical approach, so that if we do start seeing, let's say, an an opening at today's close and I start seeing some price movement to the upside, I can just look at the size of the previous days where there have been directional moves, and there could easily be a 2% move that moves halfway up the stack tomorrow. Well, that a 2% move on 350 is a $7 move. So even a move of this magnitude, of that green arrow, is a very lucrative intraday trade. So I'm going to be ready to go in that direction. By the same token, I can just as easily say that tomorrow could be day 2 of downward selling pressure. And so I'm going to be open to the possibility of a sharp move to the downside. So while we are in this no man's land, in this yellow zone, I do not have a directional bias. I'm ready to use hybrid frog techniques and play it right from the opening and then get pulled in the direction of price. So we have plenty of working examples of that over the past number of months. In fact, the entire hybrid trading workshop is based on exactly that notion of starting off with no directional bias and then letting price pull you in the direction and then using good technique to lock in gains, to add positions, and to manage the trades. Then if we do get a strong upward move, like if we got a move that looked like it was going to close above the level of the dragon, like above 350, I would take that as an indication that that could be day 1 and then day 2 of a recovery. So if we saw that, I might be tempted to hold a piece. I've already decided that I'm not going to hold a piece until we get a price that has cleared 356. That I'm not going to pick any swing trades until price has gotten back above 356. So even if we have a strong directional one-day move tomorrow, I'm not persuaded until we see new information that the previous swing trade momentum is still going. Remember, I have been of the opinion that on a long-term basis, this is unjustified. This was all about tactical momentum trading, trying to chase the money and make hay while the sun is shining. So I don't have any fundamental reason to believe that that there's going to be a immediate reversion to the bull. So that's why I'm going to play tactically until I either see price take out 356 at the peak of the RL10, or I see it break, or till I see the RL10 break down below the PSAR, which I think is going to happen probably next Monday. So there's no reason to try to hurry up and get new swing trade positions until we've had a weekend to digest it. So that's the way I'm going to be. So tomorrow, Friday, I'm expecting to see a lot of fireworks because there's going to be a lot of people playing with leverage intraday that then do not want to carry that same level of risk over the weekend. So I'm expecting directional fireworks. I don't have a bias. I just think it's going to be a big move in either direction. And then we'll see a lot of people getting out of those positions and unwinding the leverage positions so that they can be flat over the weekend. So under no circumstances, 0 circumstances, am I going to hold any new swing trade tomorrow. The only swing trade I'm going to hold is going to be the treasuries because that was built with markets money and it actually closed higher today. So that's my view of the 10-day look back. Now, if we put this in the context of the 30-day trade, what we did was we saw this amazing move. This is the 11% move from the 10-day low or the 30-day low, which was made back here, and it's made an 11% move from the swing low all the way to the swing high. And now what we saw today was about a 1/3 retracement, almost a little over a third. So this pullback is right about more like almost a 50% retracement. So we take this retracement, and if we had another day tomorrow like we had today, then you can see that we would have erased more than 20 days worth of gains. And for all practical purposes, that entire move would have been erased in 2 days of selling pressure. So this is an example of what we would call climbing the wall of worry, or climbing up the stairs one step at a time and then jumping out the window. So you'll notice that directional volatility is not symmetrical, that you get these long, painful day-by-day gains most of the time, and then you get these huge one-day sell-offs that look like this. And so a second day of momentum, just like today, could very easily look like this. So again, in 2 days, we could end up erasing 20 plus days worth of gains. And that's why, to me, you got to decide where, as you're moving up this wall of worry, you got to decide at what point do these abnormal gains become mine. So for me, it was I was going to lock in all of this move except for the last 1%. I was willing to give it 1% and ended up getting the exit up in here. So I've locked in all those gains. So there's some psychological elements at play in there. You got to be psychologically satisfied with what you end up with at the end of the day. When the fog of war lifts and you're totaling things up, are you psychologically satisfied with how much room you gave it to work and how much you were able to pull out of the market on the basis of that abnormal gain? So as we go into tomorrow, I'm going to be prepared for a large directional move, either up or down. It could be of that magnitude. That's like about a 3% additional move. And I'm ready to follow that in whichever direction it goes using hybrid frog techniques. I'm going to find the mover and exploit it, but I'm not going to hold that position overnight. Just not going to do it. I can't sleep at night over the weekend knowing I'm exposed to the potential of that much risk. Okay? So that's what I want to say about the 30-day look-back period and our posture for tomorrow. If I was still in this position, where would I be looking to put my stop? I couldn't, in all integrity, tell you to let it go any further than 344. Right? That if it starts selling, or even the low of the day, if either one of those lines are like I just can't see you holding it past today's low, because then you're going to quickly break through the 10-day low, and then you're back to the Bollinger Band mean. And if it breaks the Bollinger Band mean, there's no resistance or no support at all until you start looking back to this cluster 30 days ago. So if these three price levels break, it's Katie bar the door, and now we're getting into the shenanigans of the political silly season. So you can imagine all of the copywriters in the Democratic Party who are saying, aha, you see, the Trump economy is smoke and mirrors, and all these gains, which were paid for with Fed's money, all that did was transfer wealth to hedge funds and large cap owners. This was not a sign of a healthy economy. This was the sign of a gambling casino and paying off the power elite. So whatever. So there's a lot more of the silly season to come. So now let me shift over to, let's take a look at what happened on the sector basis. In the usual way, we're going to start with the like we always do with the U.S. markets in yellow. So the the four primaries that we look at was we said what did the S&P, the market itself, do? It was down, call it 3.5%, 3.44. The Russell was slightly better and only down 3%, 2.95. So there was some tactical recovery in that. And then the Dow was only down 2.7. So there was the uber large caps resisted the sell-off better. The tactical guys made it rebound a little bit better, but the market was just punched in the face with a 3.5% sell-off. And again, with a ATR percentage of 0.8, that's over 4 ATR of adverse moves. The other thing that we look at for the U.S. market for reference is the treasuries as the non-equity portion. And so the treasuries as the other broad U.S. index we look at, that was up a quarter at 0.28%. Okay. So while we're here, let's just take a look at the sectors that did better than the S&P. So we had consumer discretionary minus 3%. Silver, I would have thought would have done better on a defensive play, as a defensive play today, but even that was down 3%. Materials and healthcare, XLB and XLV, were down 2.7, so not quite as bad as the S&P. Emerging markets only 1.9. So this was selling that was related to tactical owners of U.S. markets. So the rest of the world was kind of going down in sympathy, but nowhere near what the market was. So if Japan was down 1.7 and Mexico 1.6, what that tells you, there's an additional 2% of sell-off just for the U.S. market. So you might say the broad global markets themselves were suffering at about a 2% loss, and then an additional 1.5 or 2% for the U.S. market. So Mexico down only 1.62. Wheat and precious metals minus 1.6. Again, I would have thought that would have done better as a defensive play, but it's already had advanced so well that maybe this was just a reduction of exposure to equities of any type, just guys raising cash until they could see what was going to settle out. So I would not be surprised to see a rebound in the precious metals if people saw this as an opportunity to put some cash to work. So cash that was pulled out to preserve profits needs a place to go. So wheat and precious metals and treasuries now become a place where that could happen. Finance was relatively better at minus 1.5. Now the beaten down energy and oil exploration, a very weak sector, actually did pretty good today, down only 0.8 and 0.7. And then Brazil was the dog that didn't bark today. We're going to see an intraday trade on Brazil. You would have thought that they would do much worse, but some of that risk premium was already baked into the cake, and so they ended up the day flat. And the only things that worked today, Simon Property Group and the commercial real estate, treasuries, and then the VIX, which we've been tracking. All of those guys who've been buying the VIX hard over the last 5 or 6 days, back around 22 to 28, got their payoff today and probably cashed legit positions on the one-day surge of 13.5%. So that's what the downside looked like. Some of the companies that did better than the market, Walmart only lost 2%, Wynn, casinos only down 2%, Nucor and Devon, so we have strength in XLB and energy, so those companies did better. Nucor Steel, Devon Energy, Caterpillar, U.S. Steel, Goldman Sachs, and Simon Property Group. So they were even better than their sectors. So when you start thinking about where to start putting money to work when things recover, you start thinking about who were the leaders in this sell-off that didn't lose as much. So we've got some ideas on some good companies that preserve some value today, like Caterpillar, U.S. Steel, Goldman. Goldman's been better than the financial sector and its peer group for a couple days in a row. So only off 1% today. So working our way back up, let's see now, more interestingly, what suffered today. So the S&P again down 3.5. The sectors that suffered, so tech was off 5.7. NY FANG, that's the ETF that tracks the tech leaders of Facebook, Amazon, Apple, Netflix, Google, and Alphabet. That was down 6%, so even worse than the broad tech. PBW, the clean energy, that looks like profit preservation on that one, down 6.7. And then in the battle of the triple leverage tech, it was a crapshoot. So TQQQs was down 15%, and TECL, which is 3 times XLK down 5.7. This was down 17%. So the broad tech sector completely cracked. And then you'll just notice all of the companies that did worse. Cisco 3.5, Intel, Facebook, uh, Safe Safe Search, the new joiner of the Dow, Home Depot, Cliff, Amazon, Twitter, Google, Microsoft. So all of the usual suspects, all of the companies that fed this excess momentum-based move to the upside, all got slaughtered today. Tesla down over, now down 20% from all-time high. So that's one that's going to be, you can already feel the sharks circling, looking to buy this on a fire sale and waiting tactically to see when they can get a better price. Again, if you loved it at 500, which a lot of people did 2 days ago, you now get to buy it on a 20% fire sale. So the size of the sell-off now has a power all of its own. So that's what it looked like in the sectors today. So I now want to track some individual companies and some trades. So I'll start with the anomaly. So this was Brazil. This is, again, the dog that didn't bark. So while the rest of the market was out getting slaughtered, Brazil, closed here and then gapped up. And then if we just apply kata number 1, the supported spring crossing, we buy it here at 31.37 with about a 10-cent initial risk at the PSAR. And then we use the Wu Wei exit, and we take the Wu Wei exit and we cash a win while the rest of the market is getting murdered. You end up cashing a move from 31.37 up to 31.80. So capturing 47 cents on a 10-cent risk, that's 5 execution R on a single position, and you're protected by the VWAP the whole way up. And you wouldn't have been wrong to have cashed a 4R win here or taken a sniper exit, but just using the Wu Wei, kata number 1, you cash on the long side 4.5 execution risk on a single position. And then if you take the supported fall crossing in the usual way, you're now short at about 31.65 with your stop at the PSAR and the Bollinger Band mean, again, about a 10-cent risk. You get in the money, and then when it collapses a second time and you take the usual RLXD exit, you end up making about 30 cents on a 10-cent risk. So between those two moves, there's 7R, and all you did was trade, the move itself was flat, but you make 7R in here just by applying kata number 1 on Brazil, which is a beautiful frog trader. And then it ended up being almost flat for the day. So tomorrow, what's Brazil going to do? Is it going to continue to build on today's success, or is it going to, out of sympathy, get murdered tomorrow? I don't know, but I'm going to trade that as a hybrid frog right from the opening, like we always do. That's why it's one of the symbols in kata number 1. Here's the Treasury play. So Treasuries, as you recall, we've had 3 or 4 positions built on the out of markets money. So this represents the turbo trade in Treasury. So we get the usual gap up, the usual sell off to yesterday's closing price, and then we get an RLXD. So I just buy it in the usual way and make a fractional gain on a sniper exit here. It sells off and finds support exactly the same level it did earlier in the day. So I buy the supported spring crossing again with a stop at the PSAR. You get the Wu Wei exit, then gets you into the Bollinger Band mean, and you just protect that move all the way up with the Bollinger Band mean. I took the sniper exit after I got a second position in on a breakout of the Z3 and a third position in when it refused to lose and everything else was getting murdered. This looked like a flight to quality. So when you measure this off, if we were just to do a quick quick accounting with your permission. So that's our standard unit of risk. So you get 1, 2, 3, 4 units of risk on the first position, probably 3 and 2. So that's about 9 R, 9 execution R, which equates to 2 position sizing Rs, which is a full weekly goal for us. So, and then treasuries finished pretty well for the day. So that was the directional move that treasuries allowed. And all you're doing again is applying kata number 1, in this case to treasuries. And then by reading the tea leaves, you can see, oh, everything's being murdered, but treasuries are going up. That makes this the lowest risk trade of all. Finally, on TQQQ, this is the one that there was a big gap down, and then at the same time I'm getting short here. This is about the same price level where the compounded swing trade positions were all exiting. So by this time, all of the longs are gone in TQQ, and I'm adopting a short side tactical play. When it breaks down, collapsing dragon below the VWAP, you get one position in with your stop in the usual place. Let me draw that box for you. Didn't have time to do that earlier. So our standard risk box on this would be right here. You get a second position in, and again, once the you get about 3 PSAR dots past the entry, this is when you now start adopting the Bollinger Band mean as your stop. And so you can see that works all the way down here, and you take a sniper exit. And this one gives you about 1, probably two execution Rs. So you preserve those profits in the usual way. And then as soon as you do, naturally, this thing rolls over. So you take the collapsing dragon and the triple SC short here in the usual way. And then you get 1, probably 2 more execution R. And then you take this, you take this in the usual way. This was the maximum favorable excursion. You get the RLXD, you just cover it. There's no way I'm interested in the long side on that one today. No way. And then we get a collapsing dragon over here again, and I pick up another R on this way. So we pick up 5 or 6 execution Rs just in the sell-off. Now, by this time, I was thinking about playing it's been stable, and now maybe there's a play up to the VWAP, but I just said, you know what, today was a day to just be thankful and take what I was going to get. And meanwhile, I was working the treasuries. So those are the 3 additional trades that I wanted to talk to show what the simple application of kata number 1 and standard trade management gets you for intraday moves. So that's what I want to say. And that's what hybrid trading is all about. How to find that trade-off and mutual support between pure swing trading and pure day trading, but to use the information and the trade patterns consistently between those time frames, and then use one to protect the other. So that's what I want to say about that. All right, I want to shift to to a review of the daily report now. Take a look at tomorrow. Although I have to really say that tomorrow should, if I'm giving you advice or recommendations, tomorrow is a day to only day trade, and only those big broad indexes with the hybrid frog in either direction. I'd be looking at Brazil, DIA, probably Twitter, and let's see, is there anything else I would want to play? Maybe the energy sector. The energy sector didn't lose as much today. The finance sector didn't lose as much today. So maybe those have some goodies. But I think if you just play it safe and stay with like Brazil, the diamonds, and the market itself, and just play intraday hybrids, you're going to be happy that you did. But just for the discipline of it, we look at the daily to start thinking about the future anyway. So let's take a look at that. Let's see, get the zoom on this. Come on, Kenneth. Shapes. Okay, so we already looked at the daily report. So we're still in a bullish, quiet move. But I want you to, yesterday, all of these things were pegged out in the green as brutally overbought. And today, we actually are seeing a minus 40 in the 3-day NDX. So if you looked at a 3-day trading range, so again, for those of you that are new, this is how this indicator works. So the way the NDX works is we take a, so here was today's horrible move. So what the NDX does is it takes a look at the 3 previous days of range. It may have been, well, yes, because it looks something like this. And it takes the 3-day look back period. The lowest low gets assigned a value of 0. The highest high of the 3-day look back gets a score of 100. And then today's price action, which ended up somewhere around here, let's say, is then projected back on this. And so you have, this would be, so it's like a thermometer. Here's 25 and there's 75. So you have an index scale of high and low. So today came in at a reading of minus 40. So when we look at that minus 40, we know just by inspection hang on, we lost audio. Stand by. Lost audio for just a moment. Mic check. Just want to make sure it's back. Mic check. Want to make sure the audio is back. Okay, good. So when we look at this number of minus 40, we know conceptually that if we took 40 of these index points, from 0 to 40, that's how far down it fell out of that 3-day look back period. Okay. So if I have a 3-day look back period like this, and then I see the 10-day look back period was 37, that means when I go back 10 days, and I'm only just going to draw these 2, we had a price action then that today's price action on the 0-day was about 40% of this down to here. So that's why it reads minus 40. But on the 10-day look back, it reads 37. So I actually didn't draw this to scale very well. That means on the scale of, I should have put it like right about, this is where the price closed. So that means so on a scale of 0 to 100 on the 10-day look back period, this comes in at a score of 37. So, that's about 2/3 and 1/3. So Audio should be back now. So when we start looking at this NDX reading, you start getting a feel for where it is in terms of a 3-day look back, a 10-day look back, a 30-day look back, the 90-day, and then the 270. So on an annual basis, the 270, and a quarterly basis, this thing is still near, even though it is sold off, it's still near the upper segment of those long look back periods. So at a glance, what this little multi-time frame NDX has given you is insight to the psychology of traders who are using different time frames to make their judgments, and how are they feeling about their trade based on how long are they typically in. So you might think of the 270-day period as a longer term buyer and holder, whereas the 30, the 10 and the 3 is kind of a shorter term trader, and that 30-day is maybe an intermediate trader. So this gives you a sense of just how painful it feels to people that have different time horizons. We are still deeply into bullish conditions at 11.8% above the 200-day moving average. The ADX reading of 44.3 is still showing a strong bullish trend despite today's one-day move. So the swing traders themselves are not panicking yet, although they're probably nervous in the service. It's still quiet, but the ATR percentage bounced all the way up to 1.13. Just 2 days ago, that was 0.8. So the ATR percentage is a pretty adaptive volatility measure, that when volatility changes for good or for bad, that move is pretty sensitive. Risk Z has been warning us about taking off some of that swing risk already, which is another, if I needed another reason not to have any swing trades tomorrow, that would be enough. But again, you can see that it's been on the decline for a while and is actually in the winter of risk Z for the last 3 or 4 days. So it's been giving us warnings that this could be the case. And you can see how the market had been overbought on the NDX for a long period of time, and now has completely collapsed down to 37. The 10-day min pain is interesting to us because this is telling us which of those symbols in that population have lost the least compared to their 10-day high, which was probably made yesterday. So Verizon, McDonald's, United Health, 3M, and Procter & Gamble. Notice no technology stocks in there, whereas the 10-day max pains, there's Apple got smashed, CRM and Microsoft, and then even the energies, Chevron, Conoco, and ExxonMobil are still suffering because they had made their losses earlier. So this gives you an idea of which companies are on the extremes in terms of resisting the sell-off. No dojis today. Everything was directional and powerful. So the ones that are highlighted in the green, Brazil, Latin America, and Treasuries were the percent winners for the day. Brazil was basically almost flat. Latin America only off 0.5, and then Treasuries up 0.28. And then the symbols that got smashed, you'll notice that XOP, oil exploration, actually made a 10-day and a 1 month new low, whereas Mexico is hovering right at its 10-day low. Silver is actually showing a pullback on a strong bull that's firing the triple screen. So silver is of interest to us. Among the Dow 30, AXP fired a overreaction short today. So that would be one that, if it showed any more weakness tomorrow, that would be a symbol to get short if you want to be shorting. Today's range was so large that nothing tests out well on the auto framer because it uses the daily range as the unit of risk. So it's no surprise that there's no auto framers that test out very well. You can notice how Cisco just got assassinated today on its NDX, and so did Chevron. Its big breakdowns using the NDX indicator, and even venerable Home Depot. This to me looks like people that were preserving gains and wanted to get flat, so they were willing to sell at any price. Yeah. Daily pinch and stretch. Only Walmart and Verizon are out of the river to their north, whereas Gold and Cisco are well below their river. On the auto framer, only two symbols test out better than 2 to 1. I wanted you to see some of the other candidates that were close, but oil and oil exploration test out well. And then this is the mechanical framing data if you're looking to swing trade one day at a time. On the RLFF, these are the symbols that are the most numbers of ATR below their long-term fair value. So Cisco's sell-off today makes it starting to become attractive on a value basis. These symbols here, this is how many ATRs they are beyond their long-term fair value. So that's like, these were overheated. But again, I'm not thinking about swing trades until at least next week. The one-day pops, there was nothing that tested out better than 2 to 1, and that's a function of the size of today's ranges. That makes it just not a good methodology for that one. But the ones that were closest to being squared away, Cisco, Gold, Intel, and Verizon are of interest. Okay. Most everything rolled over into the fall today. These in the summer were the ones that have been holding on to their gains better. But I don't need the Four Seasons right now when there was such a large volatility move. I'm really just looking for the intraday hybrid frogs in those in Brazil, the Dow, and probably energy sector. Again, this is sorted by the 10-day NDX. You can see the symbols that got smashed the most: Cisco, Home Depot, and Chevron. The ones that have resisted the sell-off the best, Dow, Verizon, and AXP, are still relatively good in their 10-day NDX. And then again, in the ETFs, you can just see how many were taken out and slaughtered today. And XOP, I'm going to add to my list as a frog champion because it broke down so much. That's also, and it's very, very liquid. That one in Mexico are both postured for great hybrid frog trading tomorrow, and energy. There it is, energy sector. XLE. That's everything I want to cover on the daily chart or the daily report today. Tomorrow, it's to be prepared. You should be rehearsing kata number 1 and start taking a look at the minimum manageable risk box for a handful of symbols that you're going to be ready to trade long or short tomorrow on the basis of find the mover and get it going. So again, this one just shows you the magnitude of that volatility decline that got it all the way to quiet. And now we're just starting to see the volatility spike back up, both on the 30-day standard deviation and then also the ATR percentage. You can see the magnitude in there. Okay. This one just tells you that the slope of the 30 had actually gotten pretty steep. And we've been talking for a while about how the excess gains of the 90-day move. I mean, this move here, that 90-day move was so extraordinary. That's why you see this box up here. Oops. You see this box up here is highlighting just how steeply that 90-day move was in terms of slope. And then you notice that the slope of the 30 was at an extreme and the slope of the 10 was at an extreme. When all three of those are extremely steep, there's nobody left to sell to. So these one-day pullbacks, almost to the edge of the river, that's what you get. Now, the last time we saw that, it went into a period of kind of sideways chop and then experienced another sell-off before it got into this big move. So an additional period of chop for the next 5 days would be the least surprising behavior of all. Okay? And even on this one, when it got well beyond, it went through a period of sideways chop before it finally gave you the move that you wanted. Right? So to me, this is new market conditions, and be ready for tactical intraday moves while everybody sorts it out. And remember, now we're 60 days away from an election, and it's going to get dumber before it gets better, before it gets smarter. And who knows if it won't get any smarter. So this is shenanigans all the way to January 1st, if you ask me. So this was an abnormal gain that we should have enjoyed and got paid. And now we're back to tactical trading. All bets are off, and we're going to be tactical from here on. So thanks so much for your kind attention. Let's be ready for tomorrow with that supported spring crossing and the hybrid frog katas. Let's be ready to execute our tactical trading plan. And that's our standard work for abnormal conditions, is you revert to kata number 1, hybrid frog and supported spring and fall crossings, and just take care of business. Okay? So that's all I got for you. Take good care, guys, and we will see you in the chat room. And to our new friends that may have been listening tonight, thanks for your kind attention.